Hi everybody, Mark from Monarch Finance Brokers here. Thank you so much for watching this video. I've been wanting to start putting together videos for a little while now, as I think it's a great way to quickly provide you with relevant information, as well as keep you up to date with changes in the home loan marketplace. I'll be zeroing in on the most important and relevant areas so that you're getting the information you need fast. While these videos cover off what I see to be the most important points, they aren't designed to go into too much detail. So it goes without saying, if you'd like to discuss anything further in relation to your own set of circumstances, I'm just a phone call or an email away. So without further ado, let's move on to the first video. Thanks for watching. Welcome to the first video, guys. Fixed interest rates are a really hot topic at the moment. Perhaps you're unsure of whether or not to fix. There are some very competitively priced fixed options currently available, but there are some things that you need to be aware of before you go ahead and lock in your rate. I've put together 5 important points to consider. My contact details are at the end if you need them. Point 1, the term of the fixed rate. In other words, how long do you want to fix your loan interest for? Generally, it's between 1 and 5 years, with banks occasionally offering longer. The interest rate is usually higher the longer you fix for. For example, in most cases, a 5-year fixed rate would be higher than a 2-year fixed rate. Ultimately, it comes down to personal preference. 2 things to take into consideration, in my opinion. The first is the economic outlook. Are they predicting a recovery in future rate increases? If so, then fixing certainly becomes more attractive. On the flip side, a declining or flat economy, and it's less attractive. Ultimately, it's a crystal ball situation in some regards, and you may want to hedge your bets by leaving some of your loan interest a variable, which I'll cover in more detail later on. The second thing to consider are your personal plans for the next few years. If you plan on selling a property or refinancing, potentially during the fixed period, then you may want to fix for a shorter period or not fix at all. And again, I'll cover off why a little later on. Very important one, fixed rates are restrictive when it comes to making additional lump sum loan payments. So if you're the type that likes to pay off your home loan as quickly as possible, and let's face it, who isn't, then you need to consider whether or not fixing is suitable for you. Some banks will not permit any additional payments to be made into their fixed interest loans. Some allow a limited amount, usually around $10,000 per year. Redraw is rarely an option. i.e., if the bank does permit some additional repayments, then you cannot access those funds once you've paid them into your loan. Lastly, in 95% of cases, you can't link an offset account to a fixed loan. Quick piece of additional info. Most banks won't allow construction loans to be fixed, if that forms part of your plan. However, you can fix once the build is complete. One very common question I get is what happens after the fixed rate expires? Basically, there are 2 options. You either remain with the same bank and negotiate a low variable interest rate or a new fixed rate at little to no cost, or you refinance to another bank depending on what else is on offer. Either way, know that if you fix, once the fixed period expires, you won't be stuck on a higher rate permanently. No matter what happens, you should try to avoid having to pay out or refinance your fixed rate loan while it is still fixed. The bank fees can be huge. Believe it or not, I had a client quoted $80,000 a few years ago. Granted, they'd fixed for 10 years at a relatively high rate just prior to rates dropping significantly, and still had several years to run on a $1 million mortgage. But even today, with rates fairly steady, fixed rate break costs can still be significant. We're paying enough to banks as it is, so why give them any more? You definitely need to factor potential break costs into your decision making at the outset. Have you ever played roulette and wished that you could place your chips on both black and red? Well, this is similar. A very commonly used structure is to split your loan, part fixed and part variable interest. There are 2 main advantages to doing this. Firstly, you're hedging your bets on interest rate movements. So if anything unexpected happens, it should have less of an impact. Secondly, and importantly, you get the repayment security of a fixed interest loan with the flexibility of a variable loan, i.e. you can make additional lump sum payments into the variable portion and link it to a 100% offset account, whilst at the same time taking advantage of currently very low fixed rates. Usually no extra fees apply to loan splitting, and it gives you the best of both worlds. Definitely worth thinking about. Well, that wraps it up, guys. Thank you again for watching, and I hope you found this informative. Fixed rates can vary significantly from bank to bank, with some lenders much more competitive in this space, so make sure you get all your options presented to you. My contact details are coming up at the end. Feel free to get in touch if you have any questions at all, or if you need help with your loan. Thanks again.